Yeah, but appreciate you guys coming out. Tonight we're just, the purpose of this meeting is really just to kind of mingle and think and learn, meet some new people with like-minded goals. Hopefully we can learn a little bit together, have some Q&A. I've got Steve Johnson, who's from Johnson Folsom, or Johnson and Company, changed the name, and he's been my accountant for 12 years. Got Dan from Cook and Castle. He's a loan officer. He's going to talk to us a little bit about loans. And then we're going to run through some case studies and some charts and graphs and learn a little bit. If you guys have questions along the way, just pipe up. We'll talk about it and get going. So first thing I wanted to present to you guys. So today's theme is retiring on real estate. We're going to be thinking ahead for the future. You take a long view. This is 777 27th Street, recent transaction. It was listed at $53,500. 3 beds, 1 bath, built in 1912, 1,380 square feet, fenced yard, and at the time, for a while, it was rented for $750 a month. How many of you think that this looks like a good deal or a reasonable deal? A few of you? All right. Well, we put the house under contract and we did our inspections. So the roof happened to have 4 layers of shingles.
Wow.
So we had 2 cedar shake and then 2 asphalt shingles on top of that. The floor joists, these are the floor joists underneath the house, looking like they got a little bit of splitting going on. You'd see where they sort of notched out some of the posts. There was a lot of plumbing where they'd cut out the floor joist to make the plumbing fit through it. So it started to weaken the joist. Obviously, that's a bad joint. The furnace was spotty. It was working, it wasn't working. And so those of you that raised your hand, how many of you are still interested in this property?
I'll raise my hand a little lower.
Okay. Well, we did... I put this house under contract 3 times. So the first buyer, we found out all this stuff. We brought in the second buyer. He still knew about it going into it, but was spooked once he started doing some bid work. And the third buyer, he was totally comfortable with it and was able to make it work. So the floor joist, the bid to repair that was only $1,200. They were going to come in and sister the joists back together, jack them up, make it right. The furnace is $1,750 to replace. That's with a brand new furnace. The roof actually, even though it had a lot of layers, Stewart Roofing came in and gave it and told us, it's 30-year architectural shingle on the top, and it's only a couple years old. It works. It's probably not going to last the full 30 years, but it's there for probably 15 or so, and because it didn't have the right ventilation with all those layers. But anyway, the roof works, so we don't have to replace it. And then the bad plumbing that you saw in that photo, our inspector took that picture of the plumbing, and in this case, it turned out it had been abandoned. And all the new plumbing was like behind it, but there were so many pipes going everywhere, he couldn't tell what was tied to what. So he just made note of it in his inspection report. So the plumbing was new. So the buyer, we ended up closing at $49,500. The seller paid $1,500 of the $3,000 in closing costs. The down payment was $9,900, and the rent-ready repairs to get it going was about $5,000. The floor joist, the furnace, and some carpet and touch-up paint, some cleaning. And so total, out of pocket's about $17,000. So what does he get out of the deal? In this case, his rents, we were going to lower the rents. The tenants that were in there previously at $750 were very low caliber. So the reason they were paying the poor credit premium, right? So the less likely you are to find a place to rent because of your bad credit or bad history, the higher price you're going to pay in rent. And so these folks I wouldn't rent to them because they were unqualified in my view, but based on income and criminal history. So we lower the rents, we can find a better quality tenant that'll be there longer, less volatile. So you take the expenses out of here. Vacancy is 6%. The market has an ambient vacancy rate right now of about 6%, maybe a little less right now. I know some investors that have in their portfolio a vacancy rate of 20%. And I don't know how they stay in business with that high of a vacancy rate. But you can expect about 6% on average if you keep your place in good condition and market it normally. You know, like you do a diligent job pushing it out there to get it filled. Last year, my vacancy rate for my own portfolio was about 4.5%. But, you know, that's kind of the exception to the rule. Property taxes on this place, $54 a month. Insurance, about $25. He's going to hire a property manager. And then repairs are $25 a month on average. Since it's a single family house, there's no expenses, right? Or utility-wise. And so you subtract his mortgage, a ridiculously low $298, and you come out to $188 a month positive cash flow on this house. How many think this is a good deal based on that? All right. Okay, so let's break it down. $188 a month is almost $2,300 a year. $2,300 divided by the 17 comes out to a 13.3% return on the cash that he put into the deal. So if you're the credit card company, that's actually a little bit better than being Discover Card or Bank of America. If you're putting that money out and getting that return. Your post fix-up value on this house, you do comparables for it. It turns out to be about $85,000 to $90,000 after fix-up. Now, to get there, we're probably going to have to do a tear-off on the roof and put in a good, a brand new roof on. We're going to need to put in probably an updated kitchen, some new carpet, maybe some curb appeal, something like that. But there's $20,000 profit in the deal. So, a word on market timing. This is the same house, and these are the sell dates on the bottom here, and the sell prices. Does anyone know the secret to finding a good deal? Dave, I know you do.
A good realtor?
An awesome realtor. Yeah. So to find a good deal, where do you find a good bargain? It's always in the same place. You have to find a motivated seller. All right, somebody who does not want their property. And typically that's where these deals are. So in 2006, this was a cash deal at $54,000. They probably rented it for a while, and then in 2008, they flipped it to somebody who did not pay their mortgage. And then in May, it was picked up as a bank-owned property for $33,000. And so my buyer bought it from the guy who paid $33,000 for $49,500. And keep in mind that it's still worth, about $85,000 to $90,000 in really good condition. So there's a lot of headroom still in the deal. There's some equity there. This guy, the $33,000 guy, he paid cash, and it was just exclusively a speculative play. He figured that the market had bottomed out, so he paid cash, and then he wholesaled it to the next guy, which was my buyer. Okay, so what have house prices done, and what are they doing? This comes from the MLS, and it shows you the median house price in Weber County for the last several years. As you can see, there's a trend line down, and then in March of last year, we stopped declining. And so our house prices have bounced up. We actually are kind of back to around 2010 price points on average. It's forecast in the next, I think there's a Case-Shiller forecast for Utah that between the last half of this year and the first half of next year, that house prices would increase about another 7%. And that's what I just heard this last couple days. So that bodes well for house prices. It means people are going to be more confident coming into the market, right? But it's not going to be anything like we saw in the past. Ignore the blue line. This red line shows you the house prices for the last 30 years. So if you bought $100,000 of property in 1979, today that house would be worth about $325,000. So So $100,000 house in '79, that's a pretty nice house, right? Probably in South Ogden or a bigger Rambler floor plan, probably an interior pool or something. It went out of fashion. Interesting to look at this though. This is kind of your trend line of appreciation over time. You can see that back in the 80s and basically the entire 80s, we sort of lagged behind where we should have been appreciation-wise, right? Like interest rates were high, the economy was we weren't very diversified as an economy here in Utah. So in the 90s, we went through that correction where we had to play catch up to where we should have been based on this trend line. And so that was when you had a lot of Californians coming in to Utah from after the Northridge quake. You had a lot of in-migration, and that pushed house prices back to where they should have been because they were below the trend. And then we overcorrected a little bit and then tracked along with inflation, early 2000s. And then you can see our most recent bubble. It's pretty obvious there, and our significant correction in prices. If you look at the very end there, though, it looks like we've hit a bottom. We've stopped moving down, and we're right where the trend line is. So, any questions about this? Yeah.
Just an interesting observation from California's. I've studied the California market a little bit because I used to live there. Their market peaked in like the late 80s, 89, 90, and then they had the aerospace layoffs, the Northridge quake that you mentioned. So their market was declining a lot from about 89 to 96 when it bottomed out, whereas Utah was going up in that time. But then in the most recent cycle, that kind of tracks with California, where California peaked in about 06, 07, and then it went down a lot, but Utah just didn't go down as much.
Right. We lagged about 2 years. Just as the edifice started to crumble in the lending market, we just kept chugging along here. At least you heard rumblings of problems, but everything seemed to be going fine here, but not necessarily in California and in Vegas. Yeah.
One thing I noticed about this chart, even though you can see how much we've come down recently, when you look at the big picture, the long term, and look how much higher it still is from 20, 30 years ago, Well, and you almost can't go wrong over the really long time frame with real estate.
Right. So between 1990 and today, you have a 251% increase on average in house prices.
And that's including the recent correction.
That's including the correction, right? So, so if you're looking for the long view, right, the retirement view, price appreciation almost doesn't really matter because it's just baked into the cake, right? As long as there's inflation, there will be price appreciation. Okay, so where are prices headed? Most of the foreclosures that were going to occur have occurred. There's very little shadow inventory. We call shadow inventory stuff the banks own but haven't put on the market to resell yet. This week I think I saw there were like 10 bank repos that were taken back in Weber County for the last week. That's a lot less than was happening during the collapse where you're seeing 50, 60 a week, coming back to the banks. So things have slowed down. There's still some opportunity to buy these houses, but the banks are being a little bit more stingy. So employment has stabilized thanks to good policy at the state capitol. We have one of the best job creating environments in the United States, and so employment is good. In fact, I was at a meeting with the Lieutenant Governor this morning, and our universities are actually seeing a decline in enrollment because they're opting to work instead of go to school. So jobs are interfering with people getting their higher education right now, which is an interesting development. Ironic, but okay. So then, so we expect I expect us to track with inflation. If the 7% is correct, we'll beat inflation a little bit. And then we're running out of buildable land, and the population here is going to double in the next 25 years or so. And so where are all these people going to go? That scarcity and supply restrictions will push prices up on a local basis. Okay, taxation with representation ain't so hot either. Steve, you're up.
I'm Steve Johnson, a CPA here in Ogden, and been here for many years. Well, I moved back here from Minnesota in what, 1978, I think it was. So I've been here a long time as a CPA. I graduated from the University of Minnesota and became a CPA out there, worked for 7 years, and then came out here. You have in front of you a little sheet talking about taxes. Now this is a summary, one-page summary of about 160 pages of a class that I attended last Wednesday. So we had 160 pages, and I kind of narrowed it down to this. And there are basically 3 items, or 2 items on the sheet, and then I'll tell you about the third one in a minute, that have to do with real estate. And well, first one is number 6. Mileage rate is now 56.5 cents a mile. Okay? So keep track of your miles. Now the easiest way to do that is make sure you have an odometer reading at the beginning of the year, one at the end of the year, so you know how far each car you had drove for that year. Then you've got to assign miles to each of those cars, come up with a mileage rate, because at 56.5 cents a mile, it's a pretty good deduction. Here again, we're talking about necessary and ordinary business expenses. The IRS has said if you keep a daily record for 2 months that are indicative of the whole year, you can interpolate what happened in those 2 months as a percentage to what happened to the cars that you drove for the whole year. So keep track of that for the 2-month period. Okay, the other one is number 8, Section 179 and bonus depreciation. Now one of the things that we're looking more at all the time is cost segregation as far as a building goes. Because the frame of the building for residential real estate is 27.5 years. But you can cost segregate that into things like carpet, light fixtures, other things, the sidewalk, a little different. If you got to replace that, you can depreciate that at a different rate. So you get accelerated depreciation on that. Bonus depreciation has been extended for 2012 and 13. $500,000 bonus depreciation on all types of, well, that's Section 179. Then bonus depreciation is on top of that. Okay, but in 2014, your Section 179 depreciation is going to be reduced to $25,000 with a $200,000 phase out. So you lose all your Section 179 if you purchase more than $200,000 of total assets for the year. So that's going to total equipment qualifying for Section 179. So that's going to decrease a lot of depreciation. Now the last thing, we printed this up at 4:30 in my office today, and at that point in time, one of my staff came in with this. IRS announces simplified office for option for claiming home office deduction. 3.4 million taxpayers claimed the home office deduction in 2010. So now they're saying, hey, simplify it. They'll give you $5 a square foot for a 300 square foot office, which is about, what, 15 feet by 20 feet, 300 square feet. They'll give you $1,500. You don't take the depreciation on the home anymore, so there's no calculating that recapture upon the sale of the home. You don't have to keep track of any of your utilities. You just take the $1,500 and that's it. No depreciation, no interest, no real estate taxes. The real estate taxes and interest, they're all taken on Schedule A, itemized deductions. Okay? So it makes it a lot simpler. That's just one of the things that's come out. Now,
What year is that for, sorry?
well, that'll start 2013, starting right now. So if this is going to be your first home you get into and you're starting a rental business, you're still subject to the rules of it being used exclusively and on a regular basis for business purposes. Okay? So, the thing I want you to remember about expenses in any business, if they're necessary and ordinary business expenses, you can deduct them. Don't cut yourself short on those things. Okay? Real estate. What are some necessary business expenses? You know, I look at a lot of my realtors that they travel down to Vegas. What do they look at down there? They'll look at golf course communities. You know, what are these homes like? How do they market them? And that almost happened up around Mount Ogden Golf Course, but it's also happening at far west out there, or Bermuda. Yeah, you know, so they're happening a lot around here now. So, you know, keep an eye on that if you've got to travel. Make that the primary purpose of the trip and deduct it. I have some people that have about 5 houses and they've traveled to Seattle and deducted that trip because they've checked with realtors what the market's doing up there, what they think it's going to do here, and they've kept some pretty good documentation on what they've done. So keep track of those things. Well, hey, it's an exciting time and it's going to be fun to watch all this happen at the government. And just keep your ears to the grindstone, and let's make those guys back in Washington handle like Jeremy. We better send him back there and get their hand going to make it go.
A few more years at least.
Hey, it's been great meeting with you. Thank you.
Thank you.
Yeah, and you know, I was 23 when I took my my first taxes over to Steve, and I'll tell you, it's been a blessing to have somebody else do my taxes for me. I just show up with all the numbers and give them to them, and they crunch it out for me. And
it's been a blessing for me too.
Yeah, it's been a mutual thing. Yeah. Well, thank you so much. Okay, yeah, and then we'll just skip through this. Okay, so why? You know, speaking about, you know, there's volatility in government, there's volatility in the economy. Despite all these things, the land is still there, right? I mean, the houses, there's houses that I own that existed prior to the Great Depression, and they're still there, and they still generated a revenue. So why is real estate so good for retirement? It has to do with the fact that it pays you monthly, regardless of the economic times that we're in. You're going to generate some revenue from that. Somebody will pay you to live in that space as long as it's tenable, and you've got an economy around the house. I mean, if you build it in Baker, California, maybe not, or the rents are going to be extremely low. You know, but and you'll have a very interesting tenant too. But it does pay you monthly. There's not many other investments that do that. You look at a stock. A stock might pay you a dividend, maybe yearly, or maybe quarterly. You might have a CD in the bank, compounding interest at 1% or less, maybe a negative interest rate. You know, you have to pay them to store your money. Real estate also holds its value over time. I was going to bring a chart of a Sony stock. You know, Sony's a big company. They make some great electronic products. If you look at their stock price over the last 30 years, it kind of does this little number, and it's hyperbolic. It just goes, or parabolic. It goes up to about, it started out at like $5 and goes up to about 90, and now today it's worth maybe 20. You know, very volatile. Stocks are very volatile, and companies obsolesce and go out of business over time. You know, there's not many companies delivering coal to your house to heat it anymore. Those companies' stock is worth zero.
Jeremy?
Oh, yeah.
One of the tough things about investments too is they'll pay you dividends you have to pay taxes on. And then you end up with a stock that was worth $90 and now it's worth 20, and you had to pay taxes on what that stock paid in dividends last year, and it's really hard for a lot of people.
Yeah, it's adding insult to injury, right?
Yeah. Real estate doesn't do that very often.
Yeah, not very often. There's a couple situations where it might, but you know, rental income is predictable. It happens every month, or should if you're a good landlord, right? If you screen your tenants properly. But the risk is pretty easy to manage. It's pretty predictable. You know what you're going to get with the tenant. And but one of the things about real estate is we need to know how to measure our income. And so today's word, if we had a vocabulary calendar and we turned over the day, it would be cap rate. And the reason I'm bringing this up is I had a client approach me, and he had a problem. He wants to retire, and he's got a limited amount of time to do it, and he wanted me to figure out what are his possibilities. And so in my research and study, I came up with a baseline to figure out what, you know, how to equalize all the properties that we're looking at and determine, okay, what is he going to have in retirement? And so cap rate is a tool that we've used to do that. It's short for capitalization rate. What it means is, what is your return going to be after expenses with no mortgage on the property? And hopefully in retirement, you don't have any mortgages you're paying on it. You want to get it to retirement without debt. At least that would be my goal. And that's the assumption that we're making here. To get this, you take your net operating income divided by your purchase price, you get your cap rate. Your net operating income is your rents minus your expenses, which include utilities, property management fees, vacancy, repairs, yada yada. It was that same list that I showed you on that first property. So when net operating income goes up, meaning your rents go up or your expenses go down, your cap rate goes up. Or if your your purchase price goes up, your cap rate goes down. So that's how the ratio works. So let's use an example. This is a listing I have in Ogden at 21st Street. It's a 7-plex. It's actually 2 properties on one lot. I got a single family house out of the picture, and then this is the 6-plex. Listed at $250, gross operating income $31.35. Looks pretty good, at least to me. But then we start going through some of the expenses. You got vacancy, taxes and insurance, property management. Your repairs are a little high. The property is a little bit old. And then your utilities are very expensive because you got one furnace heating 6 units in that old building. And so your net operating income comes down to $14.88. Multiply that out for the year. $17.8 divided by 250, you come out to 7.14%. So is that good or bad? It's okay. Yeah, it depends on your benchmark, right? Like what do you consider good? This other property we looked at here, rent $700, expenses $212, net operating income $488. You take that divided by the sales price, you come out to $11.8 as your cap rate. That's better than what we saw in the other one. If you look at the Utah market as a whole, cap rates are about 8%. And so we're going to use this 8% as our benchmark to determine what our possible cash flows are in the future. And so you say, okay, 8%, that's not a real aggressive wealth growing strategy. You know, you want to be cranking out 45%, 30%. That's, you know, where you really accelerate your wealth growth there. Well, real estate has a very unique quality about it that you can actually borrow against it. You can borrow to buy stocks, right? They call it margin. But can you borrow for 30 years to buy stocks? No. Yeah, it's a very short-term loan. So you can borrow in the long term to acquire an asset that maintains its value or appreciates over the long haul. So to show you how this leverage works in a visual illustration, that blue represents $100,000 cash at various loan amounts based on the value of the property. At 0, you just paid cash for the property. You said, I got $100,000, I'm plopping that down, and I own the house. There's no mortgage. But your return, or the amount of real estate you can buy is equal to your cash. There's no, I mean, your assets are, you just transfer your cash into an asset, and that's the dollar amount. I had a client do this. He bought, next door to my house, I have a 5-plex. I share a 0 lot line with it. I'm so glad that I do. And it's a Victorian home that's been subdivided. We call it the Frankenstein house. My kids like, Dad, the Frankenstein house. There's something wrong with it again. Yeah. So my client, the guys that bought it, paid cash for it. They plopped down. They only paid $70,000 for this 5-plex, and they thought they were kings of the hill. I mean, they just thought, this is awesome. And then they asked me what I thought, and I told them that they were going to get a PhD in property management. And they didn't understand why. They just thought everything would just come together. The driveway was 7 feet wide, so you couldn't even fit a car down it. You know, you'd scratch the paint on the sides if you tried to fit it, because it also shared a 0 lot line with another home. And anyway, so they asked me if I wanted to manage it, and about 3 weeks later, I told him I would, but I didn't hear from him. So about 3 weeks later, I get this call, you know, like exasperated on the phone. Jeremy, can you start managing it in the next 5 minutes? And I'm like, what? You know, I'm in the middle of lunch. What's going on? And he's like, oh, we just send me the papers. I'll sign them. Just take over this place for us. So I go over there. The water heater's bad. The utilities, they thought they were separate, but the studio apartment upstairs actually paid for the water heater for the whole home, and they didn't know that. And then the toilets were going bad. There's leaky pipes everywhere. So I took care of the problem. I kind of fixed the issues. We spent some of their money, but I would have these conversations with him and say, well, do you want to grow your wealth? He's like, well, I don't like the risk of getting leverage. And I said, well, you're limited in what you can do with your wealth growth because you're getting the return off your investment right now, and your cash is all tied up in this house. So to make a long story short, we ended up selling the place for $93,000 a year later because I told him I wasn't going to manage it anymore. It wasn't worth my energy. This was the place where I had the dead body, if you remember that story.
I remember that story. It was a blog.
Yeah, the ghost of Christmas present. Yeah, I can still smell it. So anyway, so I was done emotionally with that building, and they sold it for 93 cash to another investor, and so they made actually a pretty good return. They thought they were real estate geniuses, but I told them it was a fluke because they happened to buy at the exact trough in the market, and they basically wholesaled it to the next guy, and that was their profit. It was not a replicatable experience. But had they taken that money, they had $70,000. Had they taken that, they could have bought, up to $700,000 or $350,000 in real estate if they wanted to get a loan on that, and they would have had more rents and more tenants, and their asset base would have been bigger. So, bottom line, we can use cap rate to determine how much income we're going to have in the future by knowing how much real estate we own. If all the properties in Utah average 8% on a cap rate, we just have to dial in how much real estate we own, and that's our cash flow. So if we take that same chart and look at it on a cash flow basis, that $100,000 in the bank turns into $80,000 a year forever in cash flow because we bought $1 million in property with it. Now you say, oh, well, that's great, good cash flow, but what about, what about today? We have to make money today. We're making money tomorrow is awesome, but what's the cost today? So leverage is dangerous if handled improperly, right? It comes with something. What does it come with?
Risk.
Risk and a monthly payment, right? So you're going to be drowning in payments. I have no less than 24 friends that are no longer in the real estate business that were in the business in 2007. I had a friend who bought 40 houses between 2006 and 2007, and he leveraged them all at 90%. Then he took out a second mortgage with Washington Mutual. So he had 100, and it was a cash out. Took the cash, put it in the bank, and he did this for these 40 properties. So they had about $500,000 cash in a bank account, and the rents for these properties were breaking even on the payments. So, or maybe they were a little under with the cash out second mortgage, but they were taking that money from the cash and then hard money lending it and trying to make a really good return on that money, so it more than made up for the second mortgage payments. Well, that was great until they took the money in June of 2007 and decided to build 2 spec houses, two $500,000 spec houses with the money. And in August of 2007, their contractor came up to one of the partners and says, hey, I need a $50,000 draw for work I've done. And the guy's like, oh yeah, great, cut him a check. And then he drove over to the other partner who was in another part of town and says, hey, I need a $50,000 draw for the work I've done. And the guy's like, oh yeah, here. And so then the contractor split out of town, and they didn't have the money to finish their homes. And people, what happened to the market, became illiquid. So they couldn't finish their houses. The values dropped. They're upside down on these unfinished loans that were all purchased with second mortgage cash out money on 40 other houses. And so the house of cards just kind of collapsed in. The worst part is that all those first mortgages that they used were in other people's names. So they used their friends and family's credit to get the mortgages. And it was done in a little church congregation. So you had this little congregation of folks that just kind of went bad credit. Anyway, so I'm sure you guys have heard stories like that. But so how do you manage the risks? Well, you put down a larger down payment. You keep cash flows break even or positive, and you do shorter term amortizations. I mean, or any combination of the above is managing your risk. The real test is to ask yourself, would you be comfortable with the monthly payment on this property, forever, where it is right now? Or are you going to be speculating, oh, rents will increase, or I hope it appreciates? If you're comfortable right now with the cash flows on the property, you're probably doing okay. Most of the trouble that occurred is where people speculated or were placing a bet on the future. Okay, well, to talk to us a little bit about leverage and loans, I brought Dan, and I'll give you a few minutes to chat about what's possible right now.
Great, thank you. Hello, everybody. I'm Dan Hubert, Kessel & Cook Mortgage. I'm glad to be here tonight. Just a real quick history about me, where I come from. I've been a lender for 6 years. Prior to that, I was a realtor, like Jeremy, and prior to that, I was a full-time real estate investor. So I've been in the business full-time for about 12 years. I've known Jeremy for the bulk of that.
About 10.
Yeah, about 10 years. We actually met when we were both investing full-time. And I think a really cool thing you've got with the two of us is that we have weathered the storm. Okay, we have literally seen the best of times and the worst of times. Okay, I have seen. I can tell you war stories of disaster properties I've owned. I can also tell you stories of properties I made a killing on, and so and both of us have similar stories. And so having that experience, I think, is absolutely vital to your team. And we can definitely tell you what not to do and steer you in the right direction. Probably the best advice I can give you when dealing with me with financing is to just be completely honest with what you're trying to do. Okay, I've been to all the real estate seminars, I've read all the books, I've done most of the things myself, and especially with investors, it seems like they always are trying some special angle or some new strategy that they want to implement. And oftentimes when they're dealing with the lending side, they're almost afraid to tell me what they're trying to do. And I would just say, just be completely honest. Just say, here's what I'm trying to do, here's what I think I can do, and I will tell you if it can be done or not. And if it can, we will do it. I'm very creative. I go out of my way to make any deal work. Now, with that being said, things are definitely different than they used to be. Just a real quick story. Back in 2007, I did a number of these deals. I kid you not. If you had a 720 credit score or higher, you could buy $1 million home with 0 down and 0 documentation. They didn't want to, there was no pay stubs, no bank statements, no tax returns. They didn't even want to know where you worked. Nothing. Okay? It was absolutely ridiculous. And at the time, we were like, yeehaw, this is amazing. We thought real estate was going to the moon and the stock market was going to the moon. And, hindsight's 20/20. When we look back, we're like, what were we thinking? But at the time, it actually made sense because prices were going up so fast that the banks didn't even care if you skipped your payments. If you foreclosed, they would make more money selling the house than they would if you stayed in that loan. So it was a crazy time. Now on the flip side of that, as everyone knows, the market turned, things started crashing down, and banks were going out of business left and right. And the banks that remained became paranoid. They said, oh my gosh, we can't go out of business. And so then they went from one end of the pendulum clear to the other, and they wanted your firstborn and a blood sample to get a loan. Now, luckily, we've kind of come back into the middle, and things are where they should be, okay? You actually do have to have a job, and you have to make money now to get a loan. I know that's a disappointment to some people, and you have to prove it. But it's not nearly as bad as some of the stories you've heard. I still hear people saying, oh, it's impossible to get a loan now. Not true at all, okay? If you look at the handouts we've got here, on one side, you'll see file submission checklist. these are the things that the underwriters are going to want to see today in today's lending environment, okay? It's all really just straightforward, simple stuff, and the best advice I can give you is just be precise, okay? If we ask for tax returns, send all of your tax returns. Don't just send us the pages you think we need. If we ask for bank statements, send every single page, even if it's blank, okay? So if you're precise and if you're accurate with your records, getting a loan is very, very smooth, okay? Yes, you need more documentation than you used to, but it's really not a big deal. So with that, I want to talk about the different programs that are available specifically to investors, okay? If we're talking owner-occupied, totally different story, okay? There's even some zero-down programs available now. And first of all, let me ask you a question. How many own real estate now, whether it be your own house or investment property, okay? So most everybody. How many people own their own home and an investment property right now, okay? So about half or a little bit more. If you don't own a home, the first purchase you should do should be your own home, because you can leverage like crazy. You can come in with 3.5% down on FHA, even 0 down on some different programs, okay? And when Jeremy's talking about leverage, I mean, you can't get better than 0 down or 3%. That's hardly anything. Now, if you've already purchased your own home, the next step is you want to start buying investment property. So let's talk about the first program, just kind of your bread and butter investment purchase, conventional. Generally speaking, you're going to need 20% down, okay? Now, if you can put 25% down, you're going to get a little bit better rate and the fees are a little bit less, just because it's less risk to the lender, okay? With all investment property, you do have to have 6 months of reserves, and what that means is it's just savings, any kind of liquid asset where they can see that you've got a cushion where you can make those payments in the event of a vacancy, okay? So say the payment is $1,000 with everything, taxes, insurance, all that. They're going to want to see some account. It can be retirement, 401k, IRA, some liquid asset with 6 months of those payments, okay? We are not a broker. We're a direct lender, so everything's in-house. The loan officers, the processing, underwriting. I'll get to your question in just 1 second. So we're very quick. Once we have these items on the checklist, it's as little as 2 weeks from start to finish. Question, go ahead.
6 months liquid on all mortgages, right?
Just investment. So if you're buying
investment loans.
Investment loans, correct. Well, actually, that's not true. The property that you're buying needs to have 6 months reserves. If you already own other property, it's 2 months for each additional. Does that make sense? Okay. Mm-hmm. And for owner-occupied, generally speaking, you don't need any reserves at all. Okay. Certain properties do, like the jumbos. So anyway, we're really quick. When you're making offers, a lot of times you can even mention that. You can say, hey, we can close in as little as 2 weeks. And that incentivizes the seller sometimes to give you a little better deal. The second program that I want to talk about is called the Fannie Mae Home Path product. There's not as many of these out there, but if you can find them, it's a great way to take advantage of the leverage, because you can come in with just 10% down. And what is a Home Path product? Does anybody know? Correct. Yeah. So Fannie Mae is one of the biggest mortgage backers in the country. They buy a lot of the paper. So Wells Fargo may close the loan and they sell it to Fannie Mae. Okay. Freddie Mac's the other big one. So they own a ton of paper. A lot of these mortgages are owned by Fannie Mae. So if someone stops making payments and they foreclose, now that home is owned by Fannie Mae, and it becomes, when they go to resell it, it becomes a Home Path home. And when they do that, they offer special financing in conjunction with that home. And it's really a neat product. You come in with just 10% down for investment, so that's half of what you would normally need. There's no mortgage insurance and no appraisal, because they're going to be servicing the loan. They already know what it's worth, so they don't require an appraisal, which is great. The rate is a little bit higher with the Home Path, but it usually washes out when you figure that there's no mortgage insurance. It usually comes out to about the same as if you bought it conventionally with mortgage insurance. Same thing, 6 months reserves. We can close quick on those as well. Now the last product I wanted to talk about, this is a new product that we do.
Real quick,
oh yeah, go ahead.
Where do you get a list of those? Through Jeremy?
Yeah, Jeremy can pull them up on the MLS. So
You can go to the Home Path.
That'd be for owner-occupied, wouldn't it? This Home Path program?
they do both. Yeah, so you can come in as an investor.
Really?
Yeah, and you only need 10% down. The pricing is a little better if you do put the 20%. But yeah, it's a neat product. So,
but are you still subject to the loan to value, or not loan to value, but debt to income ratio and those things.
Correct, yeah. So you still have to qualify per their normal guidelines, okay, debt to income, things like that. But the big advantage to this is you would have to put 20% down, now you can 10. So it's a great way to go if you can find a house that's a home bath that you like. And feel free to ask questions as we're going along here. Now, this last product is not going to apply to everybody, but if you're in a position to do this, it is a really, really neat product. I'm going to tell you how you can get creative with this. So we have a new product. I call it the cash to cash out. Basically what it is if you can come in with cash, it doesn't have to be your own cash, and I'll tell you how to structure this. Let's just assume you have money where you can come in and buy a house with cash, okay? Now, most investors or most lenders out there are going to require at least 6 months, some 12 months, seasoning. So you have to own it for 6 to 12 months before you can do a cash out refinance based on appraised value, okay? Any lender can do a cash out refinance based on purchase price. So say you buy a house for $100,000 with cash. Now you say, oh, I want my money back, so I can buy another one. Most lenders are going to give you a maximum of $80,000, okay? 80% of what you paid for it. We now have a product where we can do 80% if it's owner-occupied, 75% if it's non-owner-occupied, off of appraised value immediately after you close. So think about this for a minute. If you can find properties that have equity, and Jeremy and I were talking before the meeting, even if it doesn't have that much equity, if you go in and fix it up a little bit, you create your own equity, okay? So let's say you buy a house for 75 grand, and after fix up, or even not after fix up, let's say it'll appraise for 100,000, okay? Well, you can literally turn right around and pull out 100% of what you paid for it and put it right back in your pocket. So you bought an investment property with zero down at the end of the day, okay? That is extremely powerful, and you can do up to 10 of these. Okay, so talk about leverage. What's your cap rate on zero? Zero out of pocket. It's infinite, right? Okay. Well, what if it didn't quite come in at 100,000? What if it appraises for 90 or 85? Well, you're still far better off than putting 20% down. Okay. Now, obviously, this isn't going to apply to everyone. Not a lot of us have the cash to do that. However, a creative strategy would be to cross-collateralize. Say you have some equity in your own home. Okay. We can structure a cash-out refinance or a home equity line. Say you've got several other properties that have equity. Okay. Perhaps there's a private money lender that would do a cross-collateral loan where he says, I'm going to put a lien on this, this, and this equity that you have in these homes, and then I'll give you the cash. So you go buy this property. So the only caveat with this product is when you go to refinance that home that you purchased, it cannot have any liens on it. So if you get a hard money loan or private money, they've got to lien something else, and then you pay cash for this one. So there's a couple loopholes that we can do, and again, that's kind of where we come in, where we're very creative. We'll try to do whatever we can to make the deals work.
I would take money from a 401k like a loan.
Yep, that'll work fine. So
just turn it right now and put
correct,
it back in.
and that's a really good way to go, especially with 401k because they're very easy to get loans against. Generally, there's not a lot of fees involved, and they're fast too. So yeah, really good way to go. Any other questions on that or any of the other
Well, I've
products?
got one property free and clear. Will you guys loan on that one?
Yes.
Pull that out and then do that scenario?
Correct, yeah. Great idea. And I'm doing one right now for another guy. And a lot of people aren't aware that this is even possible because it's such a new product. And like Jeremy was saying, in that first example, you get these guys that I've got this money and I've got to hang on to it and I'm just going to buy one property. There's so many people out there that have assets or equity that's just sitting there, Equity sounds like a neat word, but it's really not good for anything except for feeling good. Okay? You've got to use that equity and turn it and keep it going.
You can't do it just
So-
for land unless you plan on building a house maybe.
Say that again.
Can you do that on land and then say you submit plans for a house or something like that?
So you own the land free and clear and you want to pull money out?
Yeah, something like that.
It's not going to work on land, raw land. Unfortunately, the land deals are pretty horrible right now. There's very few lenders that are lending against raw land. The only ones I know of are only going like 25% loan to value. So land is a little bit more tricky. There are some construction products though, where you can come in with very little down. Any other questions? Okay.
Rates on these cash out refis or?
Yeah, good question. So rates are very reasonable. Generally, you're going to be about 1/4 to 3/8 point higher than the going rate. So say if we're 3.5, today's rate conventional, it'd be about 3 3/4, 3 7/8. So really not bad at all for investment.
And is this on residential and commercial?
Up to 4 units. So not commercial, unfortunately, but single family, 4-plex, duplex, stuff like that. So. But yeah, you guys have got my cards there. Feel free to call me anytime. And like I said, I'm in the trenches with you guys. I've owned up to 12 properties at one time. I'm constantly buying and selling, and got my hands in the market. So I've been on literally every side of the table: buyer, seller, realtor, and lender. So any questions you have, give me a call anytime, and we'll take good care of you. Thank you. Appreciate it.
It's an interesting point you make about equity, and that the equity just sits there and does nothing, or it doesn't grow wealth for you, just sitting there. Depending on where you are, in your retirement cycle, you don't necessarily want to be 90 years old pulling out a 30-year mortgage, on a property, unless you're passing the torch to the next generation who's going to be handling your estate. So it's got a proper place in our life cycles, I guess, is kind of the point. So my objective, I want to be debt-free by the time I'm retired, 65, 70. I'll probably always work because I'm a busybody, but food for thought. So all right, so a goal without a plan is just a wish, and if you don't know exactly where you're going, how will you know when you get there? So figure out today where you want to be with your retirement. Figure out when you want to retire, what you're going to need to make that work for you and your significant other. So this is a scenario here, and this is similar to the scenario that my client approached me with. He says, I've got this much cash, and in this case we'll say I've got $100,000. I want to retire in 10 years. I want to be debt-free in 10 years. What can we do? Well, don't try to memorize this, but this represents the cash that we have available to us based on how much leverage we want to use, and here's our leverage points. This is the amount of real estate we can buy with that money. So this is the table related to the charts that we saw earlier. But it also has the income on here. So if we have $1 million in real estate, and our real estate's generating an 8% return on a cap rate, we've got $80,000 of income here. If we just pay cash, we're going to get $8,000 a year for that, for buying $100,000 of property. So we know that debt comes with payment, or with a payment. In this case, so 100% down, no payment, 10% down. On a 10-year loan, $900,000, that comes out to a $92.19 payment each month at a 4.5% rate. You're only going to make about $6,500 in cash flow each month. So this is what we call an alligator, right? You're going to need to. This is going to eat you alive to the tune of $3,000 a month, going that route. So 90% is, or 10% down is too little. We got to put more down to push that payment down. So at prevailing interest rates, where's that sweet spot? It's not, zero's too, or 100% down's too much, 10% down's too little. Well, I did the math for you, and keep bumping this wrong button. The maximum LTV is 67%, so you have to put a 33% down payment to break even. This is after all your expenses, to break even on the property. So, and this is on a 10-year loan. So what happens is, if we run the math, your $100,000 is transferred into, or transformed into $24,000 a year forever into the sunset. And then you own $300,000 in assets free and clear at that point. But this is on a 10-year loan. That's really aggressive, right? If you have more time, if you want to do 30-year loans, the world's your oyster. If you want to do a 15-year loan, you can actually do a lot of things. Your maximum LTV is 90, which Just that 5-year difference makes a huge difference in the payments. So down payment 10%. This scenario allows your property to break even. Your $100,000 in the bank now is transformed into $80,000 a year income annually forever. And you got $1 million in assets. Okay, so, I mean, those numbers are kind of remarkable, but what allows it to happen right now is our extremely low interest rate environment. I mean, we're in a territory here where the market hasn't been
Ever.
Yeah, it's kind of bizarro world, but the low interest rates are a lot. It's an opportunity if you want to make it one. And interest rates will require higher down payments because your monthly payments go up, right? So you have to put more down to keep the payments in line if interest rates increase, which means you can't buy as much real estate because you're spending too much on down payments, and it reduces your final possible cash flow in the end. So just an example, from 4 to 8% would mean you'd have to put 45% down on a 10-year plan and only get $17K in income. And on a 15-year, it means you got to go to 30% and make $26,000 versus the 80, that we saw earlier. So, bottom line, we're in a real interesting historical pattern here. This is interest rates going all the way back to what is that, 71. And so you see the inflation and the problems we had in the early 80s, and interest rates have just been on a steady decline since then. And they can only go to 0. They can't go negative. There's a floor here. So the question is, what's the future going to bring? The Fed has printed well, they don't print, but they type zeros in at the end of the bank accounts when they're putting money in banks to keep them alive. There's a lot of money sitting on sidelines right now because of the uncertainty, political, economic. They're tied together at this point, unfortunately. But that money is just sitting there, kind of like dry powder. It's like gunpowder, kind of sitting in a candle factory. It's sitting there. Once that money that the banks have finds its way to Main Street in the marketplace, you're going to start seeing inflation. And the question is more of like, when is that going to happen? Nobody knows, but they've printed so much money to keep the banks alive that we're going to see it sometime. I mean, it could be 2 years, 5 years. Japan has printed a bunch of money, and they've been in a weird deflationary cycle. A lot of that has to do with their culture and how much they save. We are terrible savers here, and so I don't expect us to do a Japanese they call liquidity trap. But anyway, so now this provides an excellent opportunity to build your wealth. Now, talking about deflation, even if we had deflation, when the price of real estate goes down and we have real honest deflation, the price of milk goes down too. So if you have no debt on your property, your standard of living stays the same, right? Because the rents are going to buy the same amount of milk and bread as they did before. But if you have debt, that's when that is very problematic. And that's why we had so many people lose their shirts in the last downturn. Okay, so establish a goal today. Put your business together. Steve's given us some excellent ideas on deductions and thinking about how you're going to keep track of your expenses and taking advantage of the tax code to your own financial benefit. Think about, from a retirement perspective, you don't want to be the one swinging the hammer. I mean, maybe you do, but I don't. I don't have time right now to swing hammers. I have to have other people do that for me. Who's going to maintain your property? Do you have your contractors, your subcontractors lined up? I mean, some of you guys have a lot of experience working with these guys. Who's going to work with you on financing and getting your loans when you go to acquire things? Who's going to be your realtor and accounting, etc. Shameless promotion. Okay, so things you can do to start building your nest egg. We're almost done. So you can fix and flip, right? Buy low, sell high. Classic. Add some value to the property, resell it. The market is becoming more stable to do this in. It's been volatile for the last about 18 months. A partner and I went and bought a flip. We paid $37,000 for the house. We're like, oh yeah, slam dunk. We fixed it up. We put 35 into it. We got it on the market at 90, and just the week we put it on the market, they had that debt ceiling debate 18 months ago. And all the buyers, I don't know if you remember, but all the buyers went into the bunkers. And we had one showing in 6 weeks. It was the best looking house in the market, but the buyers were just like, no, we're not doing it. I put it on the market as a rental. I had it rented in 1 week to a person with a 750 FICO, making $60,000 a year, who was terrified to buy a house. And they paid me $700 a month to live in the house. If they bought it at our price, their payments would have been $540. I told them that every time they paid me a rent check. You know, your payment would be, you should buy this house for me, or you should become the landlord. But they still refused. Anyway, now is a better time in the market to do that. We've stabilized price-wise. Buyers are coming out of the woodwork. The key now is finding the opportunities, because all the foreclosures are mostly over with. So you have to be a little bit more patient, and then when you find the right deal, jump on it. Because in this marketplace right now, it's not finding the best deal, it's just being in the right place at the right time to make the deal work. You can fix and rent to flip. I actually prefer this method because it builds a stable foundation for the property. You can time the sell to coincide with your schedule rather than being in a panic frenzy to get it fixed up and sold real quick. That's worked well. You can buy and hold, purchase and amortize, just build that equity up and write it off into the sunset. Or you can do with Dan was talking about his product with the cash out refi, buy refi, buy refi, buy refi 10 times, and build up your asset base that way. And then finally, when you kind of get to an advanced stage and you've got a sufficient amount of real estate, you can do what we call a 1031 exchange, which prevents you or shields you from having to pay taxes on your capital gains when you transfer the property. So if you bought that house in 1979, it's worth $325 today. You paid $100 for it, and you've depreciated it all out by this time. So you're going to pay capital gains on that home. But if you did a 1031 exchange, you could buy a $350,000 home or property and not have to pay any of those taxes. But that's a whole other subject for April's seminar. Questions, comments, concerns, queries, worries? That's the presentation.
Awesome. I have a question.
Yep.
I bought a small condo right after college about 3 years ago and put 20% down, high renter to owner occupancy rate, so you can't get conventional financing. And I was lucky enough to have the 20% down, so when I bought it, my bank, they called it an in-house bank loan, where they didn't have to go to the secondary mortgage market because it was such a small loan. He even joked that they make auto loans bigger than that,
Right.
So no problem, we can do it here, that's fine. Well, I thought about selling it now and actually buying a home because I have a child and such. But I'm finding that nobody wants to buy it. If they have cash, 20% down, they usually have enough money to buy a house. So the only offers I'm getting are investors that are saying, I'll pay you whatever for 10% down, and you seller finance 7-10 years. I'm not interested in that. I want to keep it and rent it out, and it will cash flow. But I've had some advice that said, your HOA is underfunded, and you're at a high risk because your HOA, because it's underfunded, maybe they don't pay their bills and you get liens. I would sell it because your HOA is underfunded. What's your thoughts on that?
Well, HOAs are kind of a wild card, depending on your management. And I'd almost recommend becoming a member of the board of your HOA to make sure that mismanagement doesn't occur. But it's kind of like a tax. I mean, depending on what the expenses are, if they get behind that maintenance curve and they got to play catch up, it's like Ogden City with their water rates. My water rates have gone from $32 to $75 a month on average. in just a 7-year difference, because they were charging less than what it costs just to maintain the system as it is. And so that's a risk you run with HOAs. I would do some research with the HOA board, see how things are going to assess that risk. Otherwise, I mean, if you sell or finance it, you're still tied to the property. Your collateral is still at risk because the next buyer is going to assume that themselves if the HOA rates have to go up to make up for a gap in maintenance financing. So, and then he may just say, okay, well, I'll give it back to you. And so that's where you say, okay, is there enough skin in the game for that person and for you, for them to be serious about the deal and for you to be compensated if they decide to not honor their obligation. And so you have to balance that out, kind of, pencil it out. But yeah, condos are, I've got a couple condos listed in the 84404 zip code. The days on market, you're looking at about 14 to 18 months. That's how much inventory is out there right now. South Ogden's a little less, but it's still like around a year. The market for condos is not super huge, and so, I mean, if you could rent it out,
I'm sure I could rent.
Yeah, that works great. I mean, but you're just going to be married to that HOA.
Hey, Jeremy.
Yeah.
I've got a question for Steve that might help you with your question. So, suppose that you rented this property, right? From a lending perspective, after you've shown that income on your previous tax return, now we can use that income to offset the debt, okay, the mortgage. So in other words, it's not going to really hurt you to move on. Now, what if you seller financed it, though? How does that show up on taxes as far as income goes? Can he show that as income even though he doesn't own the property anymore? He's getting the money, then he's paying his mortgage, but he doesn't own the property anymore.
He still has the interest, he has the interest income and the mortgage expense. So that's zero out.
See, that's what I was thinking, yeah. So from a lending perspective, we're not going to be able to offset the debt. Okay.
He rents it.
Yeah, so that's something to keep in mind. If you did seller financing, that debt's always going to be against your debt to income on future loans. Whereas if you rent it, now we can offset it.
After how long do you have to wait? A year? 1 year?
Yeah.
Cool.
Thanks, Dave. So why aren't condos more attractive just as a rental property? It seems like it'd be an affordable rental for somebody.
Well, they're attractive rental-wise, but just not buyer-wise. Right? So, two different markets. And if you've got the cash, for a period there they were popular, but usually you find they're popular when you're in a housing supply pinch, right? If that's all that there is in housing, people will go to them. But if they can build something new and it takes the same amount of money out of pocket to get into a home, like, why not get the house that you want versus living in a condo? I mean, it's just a lower form of living. No offense.
It is. That's why I don't want to
But
buy
if it is a long-term rental, I mean, you almost have an HOA built in to take care of some of the maintenance.
Well, that's right. That's right. And you just plug that in your spreadsheet. The spreadsheets that I send out to you guys, I plug that. That's one of the items, one of the line items. You just plug that in.
I think that's why Jeremy touched on it. It all depends on your HOA, how well they run it, and if
Yeah.
you trust them, and if you're involved. And
Yeah,
we definitely need to audit this HOA.
Well, and I think when times were good.
Become your president.
Yeah. And I'll tell you, HOAs are some of the most volatile organizations to be a part of. If you want to get in spitting matches with people, be a president of HOA and try to enforce. I remember back in 2006, I owned a Rambler. It was built in 2002 in North Ogden. I bought it in 2004 with hard money, refinanced, fixed it up, rented it out, and I was chasing notices of default, and I got a bunch of NODs in this neighborhood. I'm like, oh, that's a sweet neighborhood. I own something there. So I go and I knock on like 4 doors in this neighborhood that all were defaulting. I'm like, something's going on here, but it could be a great opportunity. Well, these folks had no idea that a notice of default had been filed on their home, and they were all current on their mortgages when I was talking to them. And we were scratching our heads wondering, where did this notice of default come from? Turned out it was the HOA. They hadn't paid their dues. And so the HOA president just like, oh, we're not putting up with this anymore, and started filing NODs on the homes. So anyway, I started a civil war in the neighborhood, between the owners and the HOA president, and he quickly was ousted and replaced with somebody else. But yeah, any other questions, comments, thoughts? All right. Well, if not, appreciate you guys coming tonight, and if you got any other questions, you know where to find us.